The end of the tax year is fast approaching, and if you don't act now, you could be handing over thousands more than you need to, money that should be in your pocket, not HMRC's. So I've put together a must-do checklist of all the things that everyone should be doing before it's too late. Now you might think, well, my work sorts out my taxes, I don't need to do anything. But that's where so many people get caught out. The tax system makes it easy to assume that you're covered, but in reality, most people are missing out. First up is income. Now, I know that this might seem like a weird place to start, but there is method in the madness, so bear with me on this one. So many of the benefits or allowances that you might be entitled to depend on the income tax band that you fall into. Things like your personal savings allowance or your child benefit, to name just a couple of examples. So the first thing you need to do is find out your income for the tax year. You can check your payslip to see what your total tax has been so far in the tax year. And just for reference, here are the income tax bands. So this is the first item on the checklist. Find out what your income was this tax year and use it to work out which marginal tax band you're going to fall into. And before we dive into pensions, which is our next topic, there's a very important point that we really should discuss. That is, pretty much every threshold, exemption, tax bracket or allowance has been frozen or cut. Not just this year, but for the last few years. This is known as fiscal drag. We've discussed it a bunch of times in other videos on the channel. But what this means is that as your income increases or the value of your house goes up or your savings pot gets bigger, you're more likely to breach certain thresholds or allowances, and you may well have to start paying tax, which you hadn't before. And in some respects, this is one of the main motivating points of this video, but it's also one of the reasons why this year is a good year and an important year to take a look through your taxes properly and work out what are some of the items on the checklist that might apply to you. So we're going to move on to pensions. So I've always found that pensions suffer from this perspective problem, which is that people assume that pensions are for old people, that they can kick it into the long grass and worry about it next year. But the truth is, as we discussed in this video just here, starting early in your investing journey, including your pension, can be extremely valuable. So just taking a little bit of time can save or make you a lot of money. So let's first go through the rules and then what you should be checking. Every year, you can contribute up to £60,000 into your pension or up to 100% of your income, whichever is lower, and you'll get tax relief at your marginal income tax rate. See, we're already using the income tax band in the previous sections, and we're not going to stop here. And that leads us on to the second item on our checklist. Use your pension to lower your income tax liability. So going back to fiscal drag that we discussed a minute ago, one of the things that's very useful about pensions is that your income tax band is determined by your gross income after your pension contributions. So what this really means is you can use your pension contributions to move from one marginal tax band to another. And as we've already mentioned, but we'll discuss in more detail a bit later on, the income tax threshold that you find yourself in really determines your access to a whole host of other tax allowances. So this can be a really important starting point. Sticking with pensions, the next one is to reuse your unused pension allowances. So you can backdate unused pension allowance contributions for up to 3 years. So if you have some spare cash lying around or you really want to claim another benefit which you're currently ineligible for, then that could be a really good way of reducing your taxable income. And since we have you rummaging around for your pension details, I think this is also a really good time to do some pension spring cleaning. But fourth on the list is to consolidate your pensions. So consolidating your pensions has a few key advantages, like being able to track your retirement more easily. It's easy to access your pensions. It's easier to nominate your beneficiaries. But the most important thing is to make sure you're not getting double charged fees, which is our next point. Number 5 on the list is to review your pension fees. We often talk on this channel and on other personal finance channels about the power of compound interest, about how it's one of the most important variables when it comes to building wealth. But the other thing is that same power can also be used against you when it comes to your fees. So if I told you I was considering 2 different fund providers, one of them charged an investing fee of 1% and another charged an investing fee of 2%, and for the sake of argument, say you invest £100 a month from the age of 18 all the way up to 65, and you have an average return of 10%. The difference in those 2 funds would be a staggering £221,631, a truly staggering amount of money. So sticking with pensions, we're going to move on slightly to the state pension. From April this year, you won't be able to top up your national insurance contributions all the way back to April 2006. Instead, you'll only be able to fill gaps over the last 6 tax years. So our next one is it's important to check your national insurance record. This can basically have an impact on how much state pension you'll receive when you reach state pension age. If you need to make voluntary national insurance contributions beyond the last 6 tax years, now is really the time to do so. So with pensions in the rear view along with income, we're going to stick with investing and we're going to move on to ISAs. So a quick refresher, an ISA or individual savings account, to give it its full name, is a tax wrapper that lets you save or invest money in a tax efficient way. Now the really big advantage of ISAs is that they shield all your income, dividends and capital gains from tax. So they are definitely one of the most powerful tools we have in the UK when it comes to building wealth. You have a £20,000 limit that you can contribute every single year, but unlike with your pensions, this limit resets every year. So it's very much a case of if you don't use it, then you lose it. So the first check, obviously, for ISAs to do is to maximize your ISA contributions. Now, whilst it's very low hanging fruit vibes to bash everything, the ISA allowance is pretty generous. In fact, data from AJ Bell shows that only about 7% of people with ISAs hit the £20,000 limit each year. This is according to HMRC numbers from 2021. But if you are one of those 7%ers, you can contribute to your partner's allowances instead of yours. And if you have kids, more on that in a second. And I feel it would be remiss of me not to mention this, but there has been rampant speculation all over the place that they're going to rip up the cash ISA, with some reports that the government is going to cut the cash ISA allowance all the way down to £4,000 a year. The idea is to try and get people to invest, and preferably to invest in the UK. This is a truly nuts plan. So the next check is to think about transferring your ISA. While making use of your unused ISA allowance, you could also consider whether your existing ISA arrangements continue to be appropriate. Transferring funds from a cash ISA to a stocks and shares ISA doesn't count towards your annual ISA allowance, and you might want to do that to basically achieve better returns. However, it is also worth saying, and I don't think this is said often enough, that this depends on your personal financial goals, but also the risk that you're prepared to take. Okay, we're all done with ISAs now, and we're going to move on to savings. Now, this was something that I didn't expect to have to include in this list, but by HMRC's own figures, the amount of tax being collected from people's savings interest has increased 7-fold since 2022. And to pick up on this again, right at the beginning of the video, we mentioned that you should find out which income tax band you were going to be in. And one of the many reasons for that is the amount you can earn from interest is tied to your tax band. So take a look at this here. If you're a basic rate taxpayer, you can earn up to £1,000 per year tax-free. This is known as your personal savings allowance. But this is tapered depending on your income tax bracket. It goes down to £500 a year if you're a higher rate taxpayer, and you get nothing if you're an additional rate tax. With interest rates having gone up, this has driven up the number of people who are going to get hit by this tax. Even a modest amount of saving can start to attract taxes. So next on the list, we have avoid paying tax on your savings. And if it turns out that you might potentially owe some taxes, then consider moving some of that money into other investment accounts, which you won't be liable for tax for. The most obvious one here is a cash ISA, whilst they are still worth having. But if you're talking about larger amounts, then an ISA can be a really good place, provided you're going to be under your £20,000 a year limit. But if you don't mind locking up your money for slightly longer, then pensions can be another good option, plus you'll get the tax relief. But we should also mention that you might qualify for the starting rate. This means that you're eligible to earn up to £5,000 per year in interest tax-free, providing you earn under £12,570. Now, we did a video on this topic, the link will be in the description and at the end of the video, where we covered all this in great detail. I'd really recommend you check it out because the video goes into some really of the annoying complexities, and so you don't want to fall foul of them. Next up, we have kids. So sticking with ISAs for the time being, we've discussed what they are and what they do already, but we also have the junior ISA, which I mentioned we'd come back to. So the junior ISA has all of the benefits of a regular ISA, but with a couple of key differences. First is that you have an annual limit of £9,000 per year, but that is completely separate from your own £20,000 a year limit. But the other big difference is that kids can only access the money when they turn 18. So number 10 on the list is to contribute to your kids' ISAs. Now, at this point, typical money advice, and quite reasonable advice I might add, was that a junior ISA was only really worth it if you're maxing out your own ISA allowance. That when you put money into a junior ISA, you just end up locking it away until your kids turn 18, and that renders it kind of useless. And I must say, I don't necessarily disagree with the premise of this criticism, but I do also think it's worth mentioning there is some value in having separation between your own money and what you're putting aside for your kids. But your saving and investing for your kids doesn't have to stop at your ISA. You also have the junior SIP. In the same way you can invest into ISAs and pensions for yourself, you can also pay into them for your kids. Now, I admit it can feel a bit unnecessary to start building a pension for a child, but you can give your kids a big head start by opening a junior SIP. Like a regular pension, not only are your contributions topped up by government tax relief, but the investments have decades of time to grow. By the time your kids retire, even a modest pot now could be absolutely gigantic by the time they get to retirement, because it really takes advantage of your kids having time to let their portfolios start to grow. So while putting money aside for a child's retirement may seem a bit premature, there are advantages to starting early. So what are the rules? You can invest a maximum of £3,600 into a pension for each child, with payments receiving 20% of government tax relief. This means that a £3,600 contribution will cost you £2,880, and HMRC will top up the rest automatically. So number 11 on the list is to think about a pension for your kids. Now, we should also state the obvious, that when you're planning for a payout so far in the future, that there's going to be some serious compound growth. Just as an example, if you put £5,000 into a junior SIP when your children are born and never contributed again, not even another penny, then by the time they get to access that money at 57, there will be over £1.1 million in there, assuming an average S&P 500 rate of return of 10%. And this is the thing. In my view, the Junior SIP is a very powerful tool and doesn't get anything like the attention it deserves. But I think this is also a good chance for you to start building a legacy of wealth for your kids. It allows you to enjoy your own retirement a little more, knowing that you've already started saving for their retirement in years to come. And don't forget, if you're self-employed, then pension contributions are tax deductible, so it can be a very tax efficient way to save for your kids too. So our last topic for kids is the high income child benefit charge, and that's number 12 on our list. Make sure you still qualify for child benefit. So basically, once you earn over a certain amount, your child benefit starts to get clawed back. At the moment, child benefit is £25.60 per week for your eldest child and £16.95 for your additional children. However, child benefit rules changed in April last year. The threshold to start paying back the child benefit increased from £50,000 to £60,000. And although the threshold was raised to £60,000, had it been index linked since 2013, it would have been about £68,500 by April last year. There's that fiscal drag rearing its ugly head again. Even when they up the limit, it's not even by enough to keep up with inflation. So that's good, isn't it? Now, depending on your salary, you can take steps to lower the amount that you need to repay or to eliminate the hick-bick altogether by increasing your workplace pension contributions. Pensions, again, proving to be very useful. This is because the government looks at your net adjusted income, which is basically your income after your pension contributions have been deducted. And again, as we mentioned at the start of the video, knowing your income and therefore your marginal tax band that you're going to fall into really informs the best way to plan for this. So one thing you can do, much like with the personal savings allowance, is use your pension contributions to reduce your adjusted net income below £60,000 if you can. And there's just also one more topic we should cover whilst we're talking about kids and childcare, and that's to make sure you still qualify for free childcare. At the moment, the number of hours of free childcare you can get depends on the age of your child. If your child is between 9 months and 2 years old, you can get 15 hours free per week. And if they're between 3 and 4, you can get 30 hours of free childcare per week. Now, ask anyone who has kids, or maybe you have kids yourself. I know people who spend more on childcare than they do on their mortgage. So this is no joke. This one can be a really, really big deal. Now, the threshold at the moment is £100,000, but for working families, reducing your adjusted net income to fall below the £100,000 threshold, you can transfer some of your income to your pension pot. So again, you can use your pension contributions to make sure you still qualify for this benefit, and this can be a big one. Next, we're going to move on to capital gains tax, but let's do a quick explainer. If you sell an asset for a profit, then you might have to pay capital gains tax on it. Let's say you bought some shares for £5,000, you pick a winner, and a few years later they're worth £20,000 and you decide to cash out. You have made a profit of £15,000. Not too shabby. But that £15,000 of profit is a capital gain. Now, there is an allowance for capital gains tax that everyone gets of £3,000. It's a bit tight. It used to be well over £12,000 even as recently as 2020. So take your £15,000 capital gain, deduct your allowance, and you will have to pay tax on £12,000. But not only have they reduced the allowance, but they have also increased the rate that you have to pay. So item number 14 on our checklist is to make sure you manage your capital gains tax. Now, there is some stuff that you can do to reduce this bill. Married couples and civil partners can transfer assets between themselves without triggering what's called a taxable event. This means that a couple can basically double up on their capital gains tax allowance and shield up to £6,000 of gains. But also, if one person is a lower rate taxpayer, it may be advantageous to shift the gain to them so that the gain is taxed at a lower rate. I don't want to go too much into this one, but dividends are roughly the same with a £500 allowance each year. So that's number 15 on the checklist. Make sure you don't have a dividend tax bill and reduce it where you can. In April 2023, the tax-free dividend allowance was slashed from £2,000 to £1,000. This allowance was cut again in April last year to £500. And like with capital gains, you can also share your partner's dividend allowance. So we're going to move from dividends and capital gains to inheritance tax. Now, there's been so much chat about how inheritance tax has been fiddled with over the last few years. And I think as far as I'm concerned, that makes it even more important to check in on this one. The big change, of course, is that your pensions will now be included in the value of your estate, which they never used to be. So whilst you don't pay inheritance tax on pensions now, this will change from April 2027. And the autumn budget wasn't a great outcome in this regard, with more and more people likely to get dragged into paying a higher rate of inheritance tax. This is a tax that only about 4% of households pay every year, but this is estimated to rise to 7% by 2032. We should also note at this point that it is a pretty high rate. It's charged at 40% on the value of someone's estate over a tax-free amount of £325,000. But as always, there are exemptions. Anyone who leaves their estate to a husband, wife or civil partner isn't liable. And if the person who dies leaves their home to their children or grandchildren, the threshold goes up to £500,000. And what this really means is that when you combine two of these exemptions, it means the estate of someone who can use their late partner's allowance and leaves their home to their children or grandchildren won't be liable for inheritance tax on anything under £1 million. Frankly, it is easy to see why more people could get dragged into paying inheritance tax. The average house price in the UK is £267,200 as of numbers from last year. If house prices increase by about 3% a year, then in 7 years' time, the average house on its own will be enough to start attracting inheritance tax, even before you include pensions. Which leads us to number 16 on the checklist. Decide what you're going to do with your inheritance. Now, this one is just so important to manage, frankly, and to manage it as much as you can, as early you can. But to be fair, there is quite a lot here that you can do. Every tax year, you can gift £3,000 without any inheritance tax charge, and you can carry forward unused allowances from the previous year. So a married couple could gift as much as £12,000 before the April 6th deadline. You can also give £250 to as many people as you like. But importantly, gifts out of normal expenditure exemption is a further useful string to your bow, as it means any payments towards a child's pension or ISA will not give you an inheritance tax charge. Also exempt are wedding gifts from a parent to their children of £5,000, and this falls to £2,500 from a grandparent. And again, we have this video up here somewhere where we discuss all this in a great amount of detail, and also covers how you can pay less inheritance tax. And again, I would really recommend watching the whole video. There is so much going on here, and it's just one of those really complicated and loophole-ridden taxes. We should also touch on the 7-year rule for inheritance tax. There is basically a sliding scale, so increasing the time between a gift being made and that person eventually passing means that inheritance tax liability tapers over time. You also have the taper rule, which means that making decisions early is going to be even more important. And with the changes that are getting rolled out in 2028, it could be time to start planning now. I cannot emphasize how important it is to start your planning early when it comes to inheritance tax. Next up, we have get paid the right way. You have the trading allowance, which is a tax-free allowance for casual income of up to £1,000 per tax year. This allowance can basically be used against any trading, which means you don't need to pay tax or national insurance on the income. This is also sometimes referred to as the side hustle allowance. But if you do start to build a business on the side, then you might want to explore setting up a sole trader or limited company. This way you can offset some of your expenses and reduce your tax bill. This channel, for example, runs through a limited company, which means I can get allowances on buying camera equipment, subscriptions, and so on. So number 17 on the checklist is to make sure you're getting paid the right way. Now, this is probably best done with a qualified professional, so I think seeking advice can be a really worthwhile thing to do. If you aren't self-employed, then feel free to skip this one. But number 18 on our list is understand any changes to things you can claim for your business. As we've demonstrated, I think extensively, the rules are changing all the time. So taking some time to work with your accountant to make sure you really understand how the rules are changing, I think is such a worthwhile thing to do, to make sure that you aren't going to be leaving money on the table or claiming things that you really can't anymore. One that is often missed off the list here is that pension contributions are tax deductible. So making contributions to your pension directly from a limited company is a very tax efficient way to take money out of your company without paying masses of income tax. But always just remember that if you're paying into a pension, that money will be locked away until you retire. We're getting towards the end, moving on to our penultimate topic, which is your tax code. Now, your tax code, as we've discussed at the start of the video, basically determines how much income tax is deducted from your wages or your pension. But it is your responsibility to make sure that your tax code is correct. You might receive a tax code notice from HMRC if your tax code is changing, but you can also find it on your pay slip, your P60, your P45. If you think your tax code is wrong, you should contact HMRC, as you might be eligible for a refund, and you have up to 4 years to claim refunds if you overpaid tax. And this leads me to the next item on our checklist. Check your tax code to make sure it's correct. Again, you might want to consult a professional. And moving on to our final topic, make a plan for next year. Now, you might be saying that this tax year is barely over. Why do I need to start worrying about next tax year? And the short answer is that, and I hope we've illustrated how complicated the tax code is through this video, that with thresholds being frozen and allowances being slashed all over the place, with some until 2030, that more and more people will find that they are liable for taxes which they didn't used to be. So by starting to have a plan now, that can make sure that you don't fall foul of the tax code next year and make this whole process much easier. And the truth is that also by giving yourself more time to plan and prepare for what might be coming up or what might be changing this year with the budget in the not too distant future, it will just give you so much more flexibility and increase your options. We've talked about how this is especially the case when it comes to inheritance tax because you have the 7-year taper rule. And so the last item on the checklist is to consider consulting with a qualified professional. Let's take a moment to put this one into perspective. The UK tax code is 10 million words, or about 22,000 pages. There is no way that you can navigate it, and the rules are only getting more and more complicated. So to try and stay on top of them has been a task of its own, frankly. So if you take nothing else from this video, maybe it should be this, that if you think there is going to be valuable in it, then it might be worth talking to someone professionally. And as we've talked about right at the start of the video, all of these topics are linked to one another. Oh, and just a bonus one, 21 for the checklist, is to use a take-home pay calculator. It can just make your life so much easier to actually understand the difference between the gross amount and what's actually going to hit your bank account. But clearly, this is not financial advice, it's for information only. You should really seek the help of a qualified professional. With the budget just around the corner, we're going to be doing a reaction video to that as soon as it drops, so make sure you subscribe so you don't miss it. We also have many videos here. Links will all be in the description. We've got one video about how to avoid tax on your savings interest. We've got 15 tax changes that might be coming up. We've got an explainer on inheritance tax and how to avoid it. And we've got ISA investing tips from ISA millionaires. Thanks very much for watching Modern Money Talk. If you like this video, please like and subscribe and comment down below. Thanks very much for watching.